So your startup's doing well, or you believe that you have a company or you have a product or service which there is a strong demand for. There are customers and clients who want to avail of your service, who want to buy your product, and there is a market which is growing. And you believe that in the future, this market would represent a very, very large opportunity. Now, were you to really try and scale up this company, this service, this product yourself, it would take a significant amount of time. And in that time, you might have some other competitors who would really try and really take over the market and beat you before you even get started. That is when you actually go out and raise your round of capital, because you feel that with that round of capital, with that financing, you could scale that service or product much faster, you could go to market much faster, you could really service more clients, more customers much faster, and really form a large company in a shorter time span. So if you do have such an opportunity or such a product or such a service, then what do you do to raise your round of financing? Before you actually go out to market, remember that investors invest in companies for one simple reason, and that is to get a very handsome return on their investment. If an investor wanted just a nominal return, 10, 15, 20% per annum, they would rather invest in the public stock markets, put their money in fixed deposits, and many, many other asset classes like mutual funds. However, when an investor decides to invest in an upstart or in a company which is very, very young, maybe has a couple of team members, has a certain product, has a certain service that they're offering, has maybe a handful of customers, the investor expects that the market is growing so rapidly, growing so fast that it will become a very, very big opportunity, and that your company is placed perfectly to make the most of that opportunity and become a very large company. Now, mind you, this comes with a lot of risks, and therefore, any investment that goes into such companies, you can expect that out of every 8 or 10 of them, only 1 or 2 would actually succeed, which basically gives it a 90-95%, or some cases even more, failure rate. So when an investor actually decides to invest in your company, they are taking a significant risk. So when you're raising money from an investor, remember that for them, this is a high risk category, which means that you need to present them with a very, very large opportunity. You need to present them with a very large outcome. Only then is it truly worth their while. So an investor who invests in startups and in young companies basically has a very simple logic. They invest a large chunk, maybe 80-90% of their wealth, of their savings into safer asset classes, as I mentioned, equities, in fixed deposits, in mutual funds, and they invest maybe 10, 15, 20, now this could vary, into high risk asset classes. So some might even choose to invest in crypto. Some might even choose to invest in startups, which basically means that they want this 10, 15, 20% to give them at least a 10, 15, 20, in some cases, also 100 times return on their investment. And that is what makes this high risk asset class worth their while. So now your company, you believe, is ready to scale, or is at a stage where you can actually offer this product or service to more customers, or you need this money to build out a certain module in tech, to build out a certain platform with which you could really make it a larger company in the future. And that is when you would go in for your first round of financing. Now, first round of financing is usually, very, very simply put, a friends and family round, which is when you've exhausted all your capital, you've put in all your money, and you're seeing promise. And you believe with some more money, you could build out the service or product and really take it to some more customers. That is when you would approach your network, your well-wishers, people who care about you. So it could be family, friends, ex-colleagues, your bosses, some people who trust in you and who believe that you will actually end up doing something. And they're ready to really risk that capital or take a bet on you. And this is where it really comes down to your ecosystem of trust versus people who just believe blindly in your skill set. So a friends and family round is typically the first round of funding that is raised by young companies after the promoters or founders have exhausted their personal capital. And this friends and family round could vary. Family and friends could put anywhere between 5 lakhs to 20, 30 lakhs each. And the round could be anywhere between 20 lakhs to about 2 to 3 crores. That is typically what a friends and family round look like. Now, what you want as an outcome from the friends and family round in most cases is to really build out that product or service or the first version of it, which you could take to market and accumulate a handful of customers who can give you proper feedback on your business. So now once you've utilized that capital, which you raised from friends and family, or if you've just used your own capital, you actually might have a product or service which you believe has a lot of promise. You have a handful of customers who are giving you good feedback, on the basis of which you are consistently iterating and changing your and evolving your product. And now you think that with more capital, you could actually take this to more customers and attain what is called a PMF, or a product market fit. A product market fit is basically when there are enough customers who want your service or product and who like your service or product that they actually recommend it to more other people. Now, PMF have many definitions, but this is the most simplest definition of a PMF, which is basically when your product actually has a lot of demand or a lot of love from the market in a way that customers are actually recommending it to other people. Now, once you attain PMF, or once you actually feel that you can attain PMF, is when you try to go in for a round of angel funding. Angel funding is typically done by professionals, by people who have been a part of the ecosystem, by people who feel, by investors who feel that this company or this product or this service is in the right market and this will become a mammoth opportunity going forward, which means they could really get a good return on their investment. Now, bear in mind, angel investors do this semi-professionally, which means that they actually have a lot of experience, knowledge, know-how, network, and they also might be able to help you significantly as you look to scale your company or product into getting a product market fit or even beyond that. So getting a round of angel investors is strongly recommended, especially if you are looking to get a larger round of capital from institutional investors in the future. Now, angel investors typically would invest anywhere between 5, 10, 15, 20 lakhs in most cases, going up to a crore or sometimes even north of a crore, depending on what you require. And they would also, in most cases, come in and be part of a syndicate, which means you will either have 5, 10 angel investors or a couple of angel investors coming on with other investors, which basically forms a pool of capital in which they participate. So angel investment is once again a high risk asset class for angel investors, but these investors do have more of an understanding than just friends and family would, because they've trusted you blindly, whereas an angel investor is actually going by your product or service, and more importantly, the market that they're looking to invest into.